Okay, so the next last section that we're going to be taking a look at is closing out the closing out the year. So oftentimes, and this is what I've mentioned before, right? When we take a look at our accounting cycle, right, it really depends on how we want to deal with closing up our books. So, as we've mentioned a couple times too, is that the best way to measure profitability is generally by basing your accounting period or your accounting cycle to be completed by a given time period. In this case, a good month should give you a good idea of how your company is doing in profits. And when you do close the end of the year, what happens is you have a set of lists that you have to go ahead and go through to ensure that you're properly closing out your books. So in this case, on this page right here, you're going to have the 12 steps, or in this case, 10 steps to do to make sure that you ensure the accuracy of your accounting, but also to close up your books and etc. etc. Now, in accounting, you're going to learn that we must close out our equity, right? If we made a profit, we would close out our equity by adding our profits. If we choose to reinvest into the company, we add the profits back into the company. Or if we decide to pocket, then there's no purpose of having this. But in this case, because we're looking at a corporate standpoint has retained earnings. All right. And retained earnings could essentially be also known as your profit. Okay. So if you do have a profit, it's going to automatically be considered as your retained earnings. And what you're going to do is that this retained earnings is becoming a part of your equity. So in this case, right, QuickBooks does it automatically for you. Okay, you don't need to do the journal entry to go ahead and process that you had earned a profit. It will calculate it for you as you go through the transactions, right? It will automatically calculate it for you, and your net profit or your net income in this case, or in this case, your retained earnings will automatically calculate and convert for you. But because we're not looking at a corporate standpoint, we want to look at what happens when a sole proprietor is taking a look at this, okay? So all these steps here for the closing out the accounting cycle is going to be relevant for all companies, whether they are a corporation or they are sole proprietors. So these steps are necessary before we could talk about the very last step here, which is to transfer our profits into our equity. So first thing that we have here, okay, is we're going to enter in any depreciation entries. So once again, for first thing that you should do in order to prepare for closing is to make your adjustments, and depreciation is one of them. Okay, then it's going to be record any cash, credit card, or any loan amount with the period ending statements. Okay, so once again, we talked about what a bank reconciliation is. So chapter 5. Okay, and then it says right here, if your business has inventory. Okay, so we looked at it's in chapter 8, right? Making adjustments for inventory. Have someone physically go down to the basement, take a physical count of your inventory items, and adjust accordingly. If there's something where you need to adjust for the loss of due to the market, right? We looked at what happens when our inventory, right? When we purchase it, and as time goes by, it loses its value over time. Then you have to go ahead and make those adjustments, okay? Oftentimes when you have inventory, you might forget to accidentally sell an item or record it. So make those adjustments there. Number 4 says if you are on an accrual basis of accounting, okay, prepare general journal entries to accrue for any expenses. So what this means is that, for example, right, when you have prepaid insurance or prepaid rent. You need to adjust because how accounting works is if you're using something for that month you made a prepayment to it, you may have to adjust to reflect that you used the insurance for this month. Okay, so that's just what that is. It says ask your accountant if you need help there. Okay. Number 5 says if your business is a partnership or it is a partnership, then you're going to enter in a journal entry to distribute the profits. So once again, we don't look at partnerships per se, but for this class and the accounting class, we're looking at the standpoint as if we are a sole proprietor, a sole proprietor. So with that being said, we may not need to make adjustments here for distributing any profits or anything. But in this case, as a sole proprietor, right, you do need to enter in a journal entry to close out anything that affects your equity. So if you invest in your company, then that's going to affect your equity, right? Equity is going to be the value of your company. If you invest money into it, then you're increasing it. If you are taking away money, because if you're a sole proprietor, you have every means to take away money from your company because you and the company are one. Therefore, whatever the company makes, that is your money. Okay? So those are going to be things that you are going to that affect your equity as a sole proprietor. So you do need to make that journal entry to adjust if you did invest or if you had a profit or if you if you took money out from the company. Number 6 says run your reports, which we did in chapter 6. If you guys remember the reports, so you need to make sure that you run your profit and loss reports, your balance sheet, as well as your cash flow statement. And also, good one is to do a trial balance every once in a while. Okay, so once again, question number 6 asks you to run your reports, which we did take a look at. We took a look at that in chapter 6. Okay. And then number 7 says print out or create PDFs of the following reports that you're on your closing date. So general ledger accounts, right? So once again, balance sheet, standard, okay, your income statement, cash flows, right? So chapter 6 is dealing with any reports that are in regards to report just in general. Look in chapter 6. And chapter 7 is also making printable copies so that you can measure your profitability there. Step number 8 says back up your data. Okay, so your year-to-date backup by doing a company backup file. Okay, so that's always rule there is you should always make a backup copy in case for any reasons that you need to save or send an accountant copy, whatever it is, right? You have a backup copy of everything, right? Step number 9 says set the closing date. So what the closing date does is it allows you to lock up your data. That's it. Okay. So set your closing date for the last day of your accounting period or your accounting cycle, right? Whatever you choose to be is. And once again, once you set that closing date, what happens is it locks up the file and only the admin has access to be able to make any adjustments after closing date. But most cases, you never want to make any adjustments for any reason unless it's necessary. But in this case, once you close out, lock out those books, that's it. It's good. It's only used for one thing, to look at past transactions. It's not meant for you to edit information. So once you lock it up, that's it. It's permanently locked. You can't add anything in there and you can't edit anything in there. Okay. And then number 10 says, consider using the cleanup data file, or in this case, we learned it as condensed data. So then again, when you do lock up your transactions, right, at least when you use the cleanup data or the condensed data file, right, you can essentially delete all of the transactions. However, you could proceed with the new transactions while holding all your lists, your preferences, your items, etc., etc. All of that's going to stay in contact. So once again, those are the 10 steps that we're going to take a look at, that we're only going to take a look at 8, 9, and 10 today. So, and number 5, since the rest of the stuff we've already taken a look at. So let's go ahead and take a look at what happens when we actually need to create those entries for sole proprietors, okay? So once again, when you're dealing with a sole proprietor, you should have the following accounts. You should have an owner's draw, an owner's equity, and so on and so forth, and whatever thing that you want to do. So like such as investments, okay? Those are going to be things that are going to be considered for equity, okay? And things that affect equity are going to be owner's draw. So if you take money away from the company, investments is where you add money to the company, and of course, if you end up making profits, okay. So if you do end up making profits, then it's going to automatically calculate for you, but you do need to designate a specific place for it to go. Most cases, when you set up your company file, this should automatically populate for you as an account that exists. So if you claim yourself as a sole proprietor, these accounts are automatically going to populate, okay? So what it's saying here is you want to make sure that you want to confirm that these entries hold true, that you do have an owner's withdrawal or owner's draw account, and you do have an owner's equity account, okay? So that's what we're going to do today, since, like I said, this company file reflects as if you have that, or it reflects that you do have a corporation standpoint. So with that being said, in order for you to go ahead and take a look at it, right, we have to enter in a couple accounts that reflect that we actually have an owner's equity or a sole proprietor standpoint. So in this case, here I am at my chart of accounts, and what I'm going to do is I'm going to add 3 accounts in here, okay? I'm going to add actually just, I think 2. We're only going to do owner's draw and owner's equity. All right, so here let's start with the first one, new. Since we are a corporation standpoint, right, I have to create this so then it's applicable for you, so you guys know what to do if you guys plan on being a sole proprietor. So once again, we're going to take a look. We're looking at an equity account, okay? And I'm going to click continue, and I'm going to name my first one, okay, as owner's equity. Okay. Now, one thing I forgot to do is take a look at what accounts exist. So in this case, what I'm going to do is I'm going to go ahead and click save and close, and we can always edit that information as soon as we find out. So here, our only options is 30,000 is already taken up, so that's okay. 30,100, 31 for, okay, so we can go ahead and claim 31,200 or something like that, okay? So I'm going to go ahead and make sure I associate, oops. Okay, so again, I'm going to right click and click edit this account and associate this as 3,200, okay? All right, there it is. And then I'm going to create one more account because once again, we are looking at a corporation standpoint. So we want to add these accounts in there so then we can make the association that this is what happens, okay? All right, so owner's draw, okay? And that will be account 3,300. Okay. And then again, you can make a description saying when owner draws money, oopsies, money from company. And I'm going to save and close. Okay, so now we have two accounts. We have an owner's equity and we have an owner's draw account. Now, right here, I can see that my owner's equity is existing at 0 right now. So what you can do is you can create a journal entry to reflect that you invested in there, or you can actually create an investment account so then it links the investment as part of your equity. But in this case, I'm going to have an account balance in my equity account by making a general journal. Okay, so we're going to use the general journal twice. So in this case, because I haven't preset the equity account yet, so that's what I'm going to do here. So journal entry, okay. And what I'm going to do is I'm going to have the owner's equity, okay, and I'm going to say I put money in there, okay. So owner's equity, owner's equity is a credit account, so let's reverse that. So this is to the checking account, because when you invest money into your company, right, or in this case, increase your checking account and you're investing money into your company, then you're increasing the checking account. And what you're going to do is you are increasing the owner's equity as well. So in this case, I'm going to say I invested $30,000 into my company. All right, 30,000. So therefore, my value of my company should reflect as 30,000 because that's my original investment. And then what I'm gonna type in here is original investment. Okay, I'll highlight this, copy this, and what I'm gonna do is I'm gonna paste them in here. So there you go. Original investment is $30,000. And I'm going to go ahead and click Save and Close. So then the next time I see my equity account, it now has a balance of $30,000 in my equity. So this is what my company value is right now. Okay. So what I'm going to do is, let's say my boss decides to write himself a check because he's saying, okay, well, I did retouching for this company, therefore I'm going to compensate myself. Okay. So what you can do is two things. You can write yourself a check, right? Just exactly like how we normally would do it. You just write yourself a check. Okay. So checking. Or what you can do is you can go to the actual equity account and adjust it that way too. Or in this case, you can also use the register for the checking account and be able to do that as well. Okay, but in this case, I want to go ahead and actually have a proof of a transaction. So checking, I'm going to say print later. So you can assign the check number later. And what you're going to do is memo is going to be, okay, well, the owner, right, is Vern Black. Okay. Once again, he doesn't exist in here, so that's okay. What you're going to do is you're going to add him in there as an other because he's the owner. And I'm going to click OK. And what I'm going to say is owner draws from company. Pretty straightforward. Okay. And what you're going to do is here, I'm going to link the owner's draw account because I can. Okay, so that means I'm trying to take money away from the company. And what I want to do is I'm going to associate this as he's going to take $1,500 out. And I'm going to say as of February 15, right? So there it is. He's taking that money out. Once again, there's no association because, again, he's the owner of the company. He could do as he pleases, right? He could take money from the company whenever he'd like. So this example here is we're associating that we're making a check and he's trying to attempt to take this away from the company. And I'm going to click OK. All right. So now let's take a look again at my account, my chart of accounts. So equity. So here it is. I have an account balance in my equity account and I have an account balance in my owner's withdrawal. Notice this, my owner's withdrawal is a negative 1,500. So what that usually happens is that means I'm trying to take away money from the company, but it doesn't reflect in my actual company profile because I haven't made my adjustment, which is this one right here. So this is where you're going to write your general journal thing right here. So this is step number 5 in the closing up the period steps, right? So this is what you're going to do. You have to create a general journal entry. Company, make general journal entry, and we're going to adjust accordingly. So we're going to update my equity account, right? So in this case, we're going to say it is now the end of the month. We're doing another adjustment, okay? And this time, let me write my journal entries, okay? And what I'm going to say here for the note is that it is going to be to close equity, to close or to close accounts out to equity. Okay, because that's the one thing too that we have to adjust is that we originally have $30,000 and then now we took an owner's draw. So what's going to happen is that you're going to debit your owner's equity because you are decreasing the value of it. So owner's equity, right? You're decreasing the value of it. So therefore, you need to debit the account. And then you need to credit the owner's withdrawal or owner draw because you're essentially moving that amount out from the company. So what you're going to do here is you're going to debit for $1,500 because that's how much the account is reflecting for. And what you're going to do is you're going to take it away from the value of your company. So by doing so, this journal entry will give you a more accurate piece of information because in this case, for the month of February, I took money away from my company. So my company is no longer worth $30,000. It's worth $1,500 less. And by entering in this journal right here, and I click save and close, right? I enter my general journal. Now let's take a look at my equity accounts once again. Now my owner's draw is 0, but look at this. Now my company is now worth $28,500 because I took money away from the company. So therefore, it tells me that I am purposely making my company valued less because I'm taking money away from the company. And that's what you have to do when you are a sole proprietor. Once again, we're going to talk about retained earnings, right, which is your net income. That's going to automatically go into your equity. The only thing you have to adjust here is going to be any changes that also affect equity, which is going to be number 1 is any investments. So if you invested more money into the company, then you're going to make the adjustment where you have to increase your equity. Second thing is going to be an owner's draw. So if you take money away from the company, you're going to have to reflect it into here and make your adjustment entry to reflect your true value of your company. So in this case, my company is now worth $28,500 because I took money away from the company. And that's what you have to do as a sole proprietor, right? If you decide to go into partnerships, you're going to split the profits amongst each partner, and then you could choose from there. Do you want the partner to reinvest their section of their money? If they do, then you enter that in there as well. All right. So any questions in regards to doing that particular scenario where you have to make your adjustment accordingly? Now, on top of that too, did you notice this? I entered in a journal entry. And what it did was it carried one amount and it took away from another account. So that's exactly what a journal does, right? It allows you to move your debits and credits across the board. And an adjustment just pretty much transfers from one account to another. So, yes. All right. Any questions in regards to what you have to do as a sole proprietor?
No, I just remember to do the steps and to take notes, right? I mean, it's pretty much what's it about.
Yes, but as if you do go into the accounting program, which I think Elena, you are not going to be in.
No, but I still need to understand it.
Yes, that section right there is going to be something that you may have to learn on your own separately. But for those who are going into the accounting program or have been through the accounting program, we've already seen this particular part where, as a sole proprietor, that's what you have to do. You have to make the adjustment because, as a sole proprietor, you're in charge of your own money. So, whatever money that you invest in it, therefore, you're valuing your company a lot higher. If you take money away from it, you're going to decrease the value of your company. And that's what you have to do at the end of the accounting period, is that you have to make those adjustments. So for you, Elena, it's something that you're just going to have to kind of understand. If you can try to think about what I'm trying to say to you, like if you're investing money into your company, then your value of the company is going to increase. But if you're taking away money, then you're going to, you know,
Yeah, and you have to record it in order to keep your records straight.
correct, correct.
That's
Yes.
important.
So there you go. Any other questions in regards to closing out owner's draw as a sole proprietor? Okay. All right. All right, that's good. So, last section here is going to be doing the closing date. So, once again, we're going to take a look at steps 8, 9, and maybe 10. But let's take a look at what a closing date does. So, as I've mentioned it very briefly in the very beginning of this chapter, when you set a closing date, what you're essentially doing is you're locking the transactions, or in this case, you're locking the data file. All right. When you lock a data file, it means that no one has any can no longer access that company file unless they are the admin and they need to make any adjustments to the in that period. So, example, again, most cases, right? You would probably do it every time a month passes by, just because when we do the closing period, right, at the end of the given accounting period, you definitely want to make sure that whatever transaction happened, it happened and you move on forth and you don't look back. Because if you look back and you make a small adjustment, then everything that goes on forth makes a chain reaction and you're going to mess up a lot of your information. So, a preventative measure to ensure that is by setting a closing date to lock up the transactions. This also is a preventative measure for fraud as well. So anybody that has access to this, right, can access the old file in the past, and write themselves a check if they'd like to. So the preventative measure here is to make sure that we lock up our data files so then when we do move on to the future, right, to the next month or next year, right, all of our information will be, new, right? And all the stuff that we did in the past can never be changed ever again unless you are the admin. The admin is the only one that can lock up the data file and has the password to, in order for in case they need to add any adjustments to modify the information. But once once the data is locked, anybody that tries to access it must have a password, or the only thing that they can do is just view it. So they cannot, once it's locked, they cannot enter any transaction going on forth. Now, of course, when you lock up your data file, what happens is that anything that is in the past. So again, what happens is it will just lock up the transactions, right? But if you end up clearing up those transactions, then essentially what you're doing there is that it's, it's not going to be there anymore. It's not going to show up because you cleared them out already. So that's usually general rule of thumb here is, right, this 8, 9, and 10. First you want to do is you definitely want to back up your company file. In case you do need to edit information, at least you could have a file that reflects the information before you locked it up. Okay, so again, if you do lock it up and you do make adjustments afterwards, at least you have something to compare. So let's go ahead and take a look at how we can back up our file. So we talked about this very briefly, but now we're actually going to do it. So in this case, we're going to go up to File, and we're going to click Back Up Company. Okay? And what we're going to do is we're going to do a local backup. So what a local backup means essentially is you're just creating another file on the desktop. That's what it says, okay? Because if you know anything about computers, the computers is considered a local C drive. So that's why they use the word local. It's not to say, oh, I want it locally somewhere on my computer. No, it's not travel-wise. It's just meaning if you want a local backup, you're basically making a company file on the computer. Okay? So what you're going to do is you're going to go ahead and say, I want to make a local backup. And what you're going to do is you have two options. You can set a place for just your backup files to, constantly be saved on, or you can just go ahead and when you click next, it's gonna give you this pop-up window saying, well, where exactly in your computer do you want to save this? In this case, I'm gonna go ahead and we're gonna do that same thing once again. We're gonna go to Documents, right? And what I'm gonna do is I'm actually gonna place it into the file, the folder that I've created for you guys. You guys remember? It's going to be under QuickBooks Class. It's going to be under Student Portable Files, QuickBooks Portable Files, and it's going to be for your class. Oh, there you go, QuickBooks 426. And if I drop down, it's just going to give you all this. So I'm going to go ahead and click OK. Now, it also tells you, well, what do you want to add? You want to add the date, the time, and of course the backup, what number backup. So again, you can actually set automatically when you're using the program. Okay, it can't be running in the background. Like if you don't have the company file up, it's not going to run the background for you. It's not going to be in the background to save it for you. It's only when you have the program up and running, it will automatically save a backup copy if you want it to. So in this case, I could say that I want to have 3 backups, 4 backups, up to 10 backups, whatever it is. If you want one for every hour, then you say 24. But in this case, I just want one. I don't want to make multiple because I just only need one for now. Okay? So again, it is very common. If you do technically have multiple users use this, it's very essential that you do frequently back up your file, because in case, let's say one person you have 30 people have access to your QuickBooks, right? And they're entering in a bunch of transactions, and just one of those computers decides to crash on them, then everything is going to be affected. Okay, so you definitely want to make sure that you do back up your data file every once in a while. In this case, I only need one. Okay, and once I do that, once again, it's going to remind me to back up the company file every couple times. In this case, it's up to you if you want to set it, a reminder. So again, every time, for example, when you close out QuickBooks, right? First thing it's going to say is, wait, before you close out this program, are you sure you don't want to back up your file? That's going to be one of the things that pops up when you exit. But in this case, if you're just doing the QuickBooks, like you're just using the QuickBooks, you can actually set reminders. It's for you to back up the company file. So you could do an automatic one, or you can actually do one where you have to manually do it. So in this case, I want 0 times. I don't want my QuickBooks to remind me at all to set anything. So therefore, actually, then if that's the case, then I don't have to. I could just click this. Oh, actually, no. Sorry. The first one is to close when you close the company file, or when you close the program. So yes, I do want that, but I don't want it every time when you yeah. Okay. So then here it says you want a complete verification. So once again, when you do this, it's basically saying how do you want to verify, right? In this case, complete verification. So it says it's recommended. It's up to you how you want to do it. I'm going to say no verification, so I'm going to click OK. So then it says this, and then I'm like, okay, that's fine. So we're going to go ahead and change location. Okay, I guess I can't put it in the same file. Okay, no, use this location. There you go. And once again, now it says, okay, so we're going to go ahead and do you want to schedule it, or do you want to save it now? You could schedule it. So you could say, okay, maybe I want it to save 10 minutes from now. I can actually schedule it. So in this case, I'm going to click save now, and I'm going to click next. All right, so now it tells me, okay, is this the place that you want to save it? Once again, let's take a look at the title. It gives you the backup. It says it's a backup. It says it's the date is here is May 17th of 2021, and it gives you the timestamp too. So again, it gives you precise information, so you can pick the most accurate one every time you try to open up a backup file and you're trying to look through your files. It gives you the information here so you know which one is the most up-to-date one, right? And then I'm going to go ahead and click save. What's going to happen is you're going to go through all this. It's going to create the backup file, and there you go. And you click OK. So now I officially made my backup file, right? If I go ahead and take a look at my company, if I look at my folder, I'm going to have the backup folder, which again is a copy of the working data file. So now this is my current one. So that means if I go ahead and do any more transactions, then I would have to essentially re-back up the company file. Okay, so once again, that is going to be something that you should know to do, especially when you are working on QuickBooks pretty often. And depending on how your company is, it is recommended that you should do it often. Especially if you have many people using the same file, you definitely want to make sure that you do have that backup there. So that's how you back up a company file. All right, any questions there?
Yeah, when you say the lockup date, do you have to remember that date so you can make sure that everything is set the way you want it? So when it locks up, everything is still be the way you wanted it?
Okay, so that's
Right?
that's what we're going to talk about next, is when we lock up our data. That was just backing up our data.
Yeah, okay.
Okay, so backing up is separate than locking up. So backing up, just make sure that whatever last transaction that you saved, right, that you're creating a copy just in case for any reason the file gets corrupted. What do you call it? Maybe one of the computers decide to crash because too many people are using the file at once. So that's what the backup does, is that it just saves the last transaction and it saves a copy on your desktop or wherever it is, right? So then in case for any reason that file does get corrupted, at least you have a backup so you don't have to enter in all the work all over again. But now we're going to talk about how to lock the date. Now, once you lock it, you cannot change it. Okay, so that's very important that you know. Once you set the closing date to lock up your files, you cannot change it. Okay, so once it's locked, it's locked. Yeah. Okay. All right. So there are 2 ways that you can lock your company file. Okay. Number 1 is going to go to company, and you have the option to set your closing date. Okay, right here, set closing date. Okay. Now if I click on that, it's going to take me to, what do you know, my edit preferences. So therefore, the second one you could do is edit preferences, and you're going to go to accounting. All right, and make sure that you're on company. So here, we're going to take a look at this section down below here where we're going to set our closing date. So when we set the closing date, once again, you're going to select this right here. Now, because the thing about this is that if you're the admin, you're the only one that can set the closing date. And once again, once you set the closing date, you can't enter any transactions after that or anything that's relevant in the year. So right now I'm in the middle of February, I believe. So in this case, I'm going to set a different date so then I can still enter my transactions in. So when I set this closing date, so that's why in the very, very, very beginning, they tell you when we went through the Easy Step interview is to set your closing date. Don't ever do that. Wait till the very end when you're for sure on when you want to set your closing date. So then this is an example here where we're going back here and saying, okay, well, let's go ahead and actually start scheduling my closing date. So once again, what I'm going to do here is I'm going to go ahead and select the end of this year, just so then the next time I enter in a transaction, I'm still able to enter in without any abrupt things or notifications saying, hey, you can't enter a transaction past this date. So I'm going to make sure I write in here December 31st of this year. So that means I still can access, I can still enter in all the, retroactive transactions. Because if I made it today, that means I cannot enter in any transaction that happened prior to that. I would have to continue going on forth with either May set 18 or I go ahead and do June 1st of this year. So that's the important thing about this is if you set the closing date. So because I'm looking at QuickBooks as a retroactive perspective, right? Therefore, right now, it's 2021 and I'm entering in transactions that happened in 2019. So by setting my date, if I were to do it as of today, I can no longer do any of the examples here in the book because they're all retroactive things. Like you have to put it in the past. So if I set my locking date to be as of today, I can no longer enter any transactions before the 17th. So that means going on forth, I can only enter in as of the 18th, which is tomorrow. So therefore, I'd be completely out of this book for the rest of the day. All right? So that's why it's very important that you do make sure that the closing date of your transaction is going to be whatever date that you are for surely going to be. So once again, if you're deciding to set it at the end of the year, you definitely want to make sure that you add the December 31st into your transactions, because if you set it as of December 31st, then you're done for. You want to make sure it's going to be the day after. So it has to be January 1st of 2022. That way it covers the 31st and you're able to make your adjustment entries as accordingly. But in this case, I'm going to make it the 31st of 2021. And what you're going to do is when you do set this as admin, you have to create a password. So in this case, my password here is, I believe they say it's ABC123. Or actually, I think it's ABCD1234. Oh, no, I think it was right. ABC123. And you want to make sure that your password is complex enough because it will give you an error message saying, hey, your password is not complex enough. So ABC123. Okay.
4.
Okay, so it is 1, 2, 3, 4.
And it's a capital A.
And it's a capital A? Okay. So you have to make it as complex as possible because, once again, this is sensible data. You definitely don't want this information lingering around, and you don't want to make a password too easy, because again, you have credit card information. It's really unfortunate if someone is able to hack your computer. And once again, if you do a really bad password, like if I did ABC123, it will not let me bypass it. It will give me an error message saying my password is not complex enough. So then in this case, there you go. So I saved it, so that means the next time I look at it, I won't be able to change it. Okay, so therefore, here it is. It's locked up. Now, in this case, yeah, so there you go. I can change the password at any given time, but I won't be able to change the setting. Or if I set the date as today, I won't be able to go back and fix it. But because it's December of 31st, it's way out in the future, then yes, I can change it. So that's the one thing that you had to make a rule here, is that when you set the closing date, if you set it as of today, you can't go back and fix it. All right? But if you set it in the future, then yes, you do have time to fix it. Okay? So once again, once you set that closing date, therefore, I have until December 31st to enter in all the transactions that I need to finish up my accounting year. Okay? Any questions on setting the closing date? Okay. Once again, once you close that, once December 31st comes around, therefore, any transaction that you need to fix in the past, you unfortunately need a password to be able to unlock it and be able to add in any adjustments that you need to do. But once it's locked, it's locked. Okay. All right. Okay. And once again, we took a look at the condensed data. So what you're going to do, what happens is all the information that you have on here is just going to be cleared. And that's pretty much it. So I guess we can go ahead and take a look at that. So if we go ahead and go to edit and we choose utilities and we're going to condense our data, we get this window right here. Okay, we already backed up our company file, so we're good to go. So once again, we're going to remove the transactions that you select from your company. Okay, and we're gonna click next. Okay, so now it's gonna ask us this. Okay, it's gonna ask us, do you want transactions before a specific date? And if you do, then you choose the date. Okay, so remove transactions before. So in this case, it gives me a date. All right, so I'm going to go ahead and once again, all of our transactions are as of 2019. So 2019, excuse me. So what I'm going to do is I'm going to say, I'm going to remove everything before the 31st of the 2019. Okay, so once again, you can set dates, right? So if you have any adjustments that are dealt with at the end of the month, then you definitely want to don't delete it. You might want to keep some of those or anything, so on and so forth. If you have a bill, right, that you've entered in but the due date is afterwards, you're safe there because it will hold on to that information, because again, that transaction is going to happen in the future. That transaction is going to stay there. So if you guys remember, right, I had a few transactions. I think I had one bill, right? If you guys remember that one bill, I'm going to go ahead and say I want to delete any transactions that is as of the 31st. Okay, so let's take a look before I do that. I don't want to do this just yet. I want to make sure that I have actually like some people here. So let's take a look at my customers. So here we have a bunch of transactions here as of 2019, right? These are all February and March dates here. So notice that all of these are people who haven't paid us yet. Okay. So let's go see what happens when I do that, because in this case, I never got paid. So these things will probably stay there, because the essential idea is that you want to make sure that you want the ones that people haven't owed you, you want those ones to carry over in the future. But let's take a look at Bob Mason, because I remember he should have a lot of transactions. Okay, so no bill payments there. And what about Miranda's Corner? No bill payment there, or they didn't pay us. No. So all of these are probably going to still be here because they never made a payment yet. So, but let's go ahead and take a look at that once again. So here, file, utilities, and we're going to do condensed data. Okay. Next. So here again, it's asking you want to set a date of when the transactions are going to be. Okay, so here I'm going to go ahead and set that as the 1st of 2020. You could delete all transactions if you like, but once again, you definitely want to make sure that you carry some of them over. Okay, I'm going to click next. So then now the next question says, how should inventory be condensed? So here you could choose, right? You could do summarized version of it, or you want to keep the inventory transactions details. And that's what I want to do. I want to make sure I carry that over, that I have the inventory. Okay. Then it's going to ask you these questions here. Do you want to remove the following transactions? So this is where you get to pick and choose. Do you want to keep unclassified information? No. Okay, do you want to keep transactions that are marked as to be printed? No. So I do have a check in there. Do I want invoices and estimates that are to be sent? No, I don't want to keep that. So in this case, that's the details here. I'm just going to just go ahead and click next. And then now it says here, do you want to remove unused lists and information? So it lets you choose to remove any accounts that you've never used. So in this case, yes, I want to keep them. I don't want to delete them. Okay, so the question is, do you want to remove them? Unused accounts, of course, I want to keep them. Okay, I also want to keep customers and jobs. Okay, wait, hold on. Do you want to remove unused list entries? So this is a case in case you enter a customer that, I want to keep out all customers, all vendors, and other names that I haven't entered in here. I want to keep them all. I definitely want to keep my items as well. No, I don't want to keep that. Classes I don't care for. Next. Okay, and there you go. Here, and then you need to click Beacon Condense. So now it's going into this mode where it's condensing and deleting all the transactions that exist in the QuickBooks prior to the 2020 of January. Okay. And there you go. Once it's done, the things that will be still kept on there is going to be your items, your lists, and so on and so forth. Okay. Okay. There it is. It's deleting everything. Okay. And this also depends on how quick your computer is. So a lot of times, especially if you have a slower computer, it will take a lot more time to start deleting all the transactions. But now it's deleting. Okay. Okay. I just hope it does, my computer doesn't crash. And reducing company file size. So step 4 out of 4. So that's what it's doing. Okay. So then when you do go on fourth, right, you have all of your lists and everything that is still intact is going to be your lists and your items and so on and so forth, your accounts. Okay. So the next time you open up this company file, the only thing is that you'll only keep the transactions that happen after the set date. Okay, so any bills or information that are not used or anything like that, So for example, let's go ahead and take a look at my customers. I should still have them because they still have balances on them. But and yep, see, I still have them because they never paid me. So therefore they could pay me after January 1st, 2020. So these ones are still here. Okay. But anything that happened prior to that is going to be gone. So I have no idea what other transactions that have been paid. So most likely the bills that we paid prior to the 2019, they're probably all gone. Okay. And on top of that, let me see. I think I only had like a couple vendors that I still owed. But in this case, all my information, including, let's go to my chart of accounts. Okay, all of those are still going to be there. So all of my chart of accounts are there, right? All my items that I sell are still going to be there, okay, with their account balances right here. So they're also there because I selected that I wanted to keep it. Okay, so there you go. That's how you condense your file, and then therefore moving on forth, right? Anything that you enter in as of now, you could continue on forth using the same exact information, right? And on top of that, right, it keeps the information that you haven't dealt with. So just such as my customers, right? It didn't delete any of this information because they still owed me money. So therefore, if I had received a payment, right, and it was for 2019, therefore that invoice and that payment would have been gone. Okay. So that's how you do the condense, right? Any questions in regards to chapter 13? So those are going to be the necessary steps that you need to do in order to successfully close up your accounting period and go ahead and start the new one. Any questions? Okay, so let's go ahead and do the review questions and we can be free to go. So, question number 1. Which of the following tasks does QuickBooks perform automatically at the end of the year? A, let's take a look. Creates adjusting journal entries to income and expenses account. Does it do that automatically for you? No. You income expenses are something you have to manually do. Okay. So C, you're going to adjust the balances in the retained earnings account, and it's going to reflect in the net income / for the year. That is correct. So as you remember on that one page, right, it will automatically calculate the retained earnings for you at the end of the year. Okay. All right, number 2. Number 2 says entering a date in the closing date field, okay, accomplishes which of the following? C, it locks up the data file. So then, for example, right, for anybody to protect themselves from entering in any transactions after it's been closed, right, it's going to require a password. So then once again, any transactions that happen before the closing date, you're not able to edit, modify unless you have a password. So in this case, C is the correct answer. Okay, it locks it up. Okay. Number 3 says, okay, voiding and deleting transactions do the following. C, it zeroes out the debits and credits specified, okay, by the transactions. Yes. So in this case, right, it's asking, no, C is the correct answer. Okay. Because this one is asking for both voiding and deleting. Now let's take a look at A. A says it keeps a record in the keeps the record of the date and the number and etc. This one, when you void something, it keeps the information there. As in, then the next time you open up the file, you will see that this transaction has been voided. It doesn't remove it off of whatever that you're looking at. If it's a check, it will still be there, but it's not going to delete. It's not going to remove it. Whereas B says, right, it completely removes the details off of the transaction. That is exactly what deleting does. The question here is, what does both of them do? So in this case, right, B, voiding, does not remove the file at all. It keeps it there.
Well, maybe not voiding by itself, but voiding and deleting.
Voiding and
Maybe if the
deleting.
question was worded voiding or deleting. I don't know.
It's not voiding or deleting. In this case, it has what do both of them essentially do at the end of the day? That's what the question is asking. So in this case, if it was or, then A and B would be your answer. Okay, or A B C would be your answer if it's or.
No, I'm just confused a little bit by the wording. Say by that and deleting. Like if you delete it, if you void it and then delete it, it's going to remove all the details of the transaction. That's why I was confused. Is because the and
Yeah, me
deleting.
too.
Okay, I get it now. Oh, okay.
Void it and delete it, then it does B and C.
Yes, it does do this. That's right. That if you're looking at that standpoint, yes, that's correct. Okay. Yeah. Okay. In this one, it's asking you what does voiding and deleting. So they're one is to void the transaction and one is to delete the transaction. What do they have in common? That's what this question is asking. The common thing here is that it zeroes out the account at the end of the day. Okay, so I see how that one can be confusing. Once again, I didn't write this book, Intuit did, so.
Yeah, no.
Well, that's a good observation. I didn't think of it that way.
Yeah, that's why I was confused myself.
So, okay, so in this case, depending on what the question is asking, usually if by looking at the answers, so it says it's I think, and if you look at the answers, then it's kind of saying what does voiding a transaction do and what does deleting a transaction do? What do they both do in common? I guess that's how you have to analyze this question. But yes, I can see how D can be the correct answer as well. All right. So that will be one of those questions. If you do get this on your exam, it's going to be a question where you may have to second guess it. Okay. So once again, the questions can be due to how you interpret the questions. All right, number 4 says here to make an adjustment to items as well as their associated accounts, you would have to create we talked about the general journal entry. Okay. Now, let's look at the question carefully. If you're trying to adjust items, if you're trying to adjust just items,
Was D?
D, memorize transactions. No. Memorize transactions is when you want to save some time. So if you have a reoccurring bill, you could just click on it and it would pop up for all the information for you. Fixed assets. Did we talk about fixed assets in this chapter? $0 transaction or $0 check is going to be for items only. Okay, so if you remember, I'm going to show you a general journal once again. General journal. If I make a general journal entry, can I make an entry for items? No, I can only do accounts only. Whereas if I go ahead and write a $0 check, right? I click on write a check, I have the option right here where I can do just accounts or I can actually choose items. Okay, so that's a trick question there because it could have been A, but the only thing is A cannot make adjustments to items. It can only make adjustments to just accounts.
So it'll be C.
It is C, yes. All right, last but not least, question number 5. Okay, at the end of the year, you should perform the following. Yes, D. All of these are things that you should perform, okay? Such as entering depreciation. So once again, that page that has the 10 steps of things that you have to consider when you're closing out your books is going to enlist all of these. So again, this was step number 1 was to enter depreciation. I think step 2 was inventory. And then step 5 was if you are a partnership or a sole proprietor, you need to distribute your profits. And of course, so all of these are going to be the part of the 10 steps that you have to do when you want to properly close out your books. Okay. All right. So good job, everybody. So this is what I was talking about when I was mentioning that every chapter has these kind of extra problems that you can do. It just helps you navigate QuickBooks a little more. So what I usually tell my students is that I want you guys to do this on your own as a way of having you practice what the lesson was. So yes, if you'd like, we can take the time in class to go home and go ahead and go over it like on Wednesday. But again, this is meant for you to do on your own at home.